All right, let's just get straight to it. The playbook that dominated investing for, the last 50 years? It's starting to look a little rusty. We're in a completely new game now. So the big question is, how do you find an edge when the very physics of the market seem to be changing? That's what we're going to break down today. Let's dive in.
For more than a decade, this single quote was basically the entire strategy. It was simple, right? Just bet on companies that dealt in pure information, not physical stuff, and you were pretty much guaranteed to win. And for a lot of people, that was an incredibly profitable story. But now that we have some distance, we have to stop and ask a pretty tough question. Was that narrative just too simple? Is software really just gobbling up everything in its path? Or is what's happening between the digital and the physical worlds a whole lot messier than we first thought?
And this is where the story gets complicated. Think about WeWork, Peloton, Uber, Lyft. These were all sold as these incredible tech disruptors, right? But what happened? They slammed right into the messy, expensive reality of the physical world. Office space, bikes, cars, atoms, not just bits. It turns out the old rules of economics didn't just pack up and leave. They still matter a lot.
Okay, so what we need is a new framework. First, we'll look at this shift from the old rules to this new game. Then we're going to dig into 4 key edges every investor needs today: the analytical edge, the behavioral edge, the informational edge, and finally, this incredible moat being built by today's superstar companies.
Let's start with the big picture, the real heart of the problem. What's going on here isn't just another trend. It's a fundamental shift in how markets even work, a change in the basic physics of how value gets created and how it's kept.
See, in the old world, the world of factories and machines, companies always hit a wall. It was called diminishing returns. You get bigger, things get more complicated, costs go up, and your profits get pulled right back down to the average. But in this new world of intangible assets, we're talking software, patents, brands, the rules are flipped upside down. It's a world of increasing returns, where the bigger you get, the stronger you get, creating markets where 1 or 2 companies can take, almost everything.
So that leads us to the billion-dollar question for any investor, right? How can you possibly tell the difference between a company that has a real, durable advantage and one that just has a good story? This is all about having an analytical edge.
For a business to really get this magic of increasing returns working for them, you need all 3 of these things. First, huge upfront cost to even create the thing. Second, powerful network effects, where it gets better for everyone as more people use it. And third, real customer lock-in, where it's a genuine pain to leave. You miss just one of those, and the whole model could just, poof, fall apart.
This quote just nails it. It perfectly shows the wild economics of intangible goods. Think about it. A massive investment to make the first one, and then the cost to make another one is practically zero. That creates a cost advantage at scale that old-school, asset-heavy businesses just can't even dream of competing with.
And this brings us to a really cool idea: path dependence. In these new markets, how you start matters a lot. A tiny head start, maybe even a lucky break, can set off a chain reaction that just cements a winner in place. The classic example is the QWERTY keyboard. It's definitely not the most efficient layout, but it got there first, and now it's basically irreversible. Spotting that dynamic before anyone else, that's a huge edge.
But, and this is a really big but, an intangible asset is totally worthless if you can't protect it. This is what we call excludability. A drug company uses a patent to lock down its formula, right? That gives them a legal monopoly for a time. Without that protection, whether it's a patent or some kind of tech barrier, there's no real lock-in. And without lock-in, there are no sustainable increasing returns, period.
Okay, let's build on that. Because markets aren't just about numbers on a spreadsheet. They're driven by people, by psychology, by groupthink, by belief. And if you can understand that, you've got a behavioral edge. Just think about this for a second. It's a Thursday night. You want to go to that cool new bar. You go if you think it'll be busy, but not too busy. Simple, right? But here's the catch. If everybody else thinks the exact same thing and acts on it, the bar gets totally mobbed and your original belief was dead wrong. This little thought experiment is called the L for all bar problem, and it's a perfect miniature model of how financial markets actually behave.
So this is the loop that every single one of us is in, whether we know it or not. We're not perfect calculators. We're more like scientists in a lab. We create a theory, we test it, we see what happens, and we adjust. The problem is, most of our theories, our mental models, are kind of flawed. The real behavioral edge comes from figuring out where the crowd's beliefs are weak.
So yeah, the market isn't a machine you can predict. It's much more like an ecosystem. You have all these different beliefs and strategies, almost like different species, all competing to survive. Some get popular and create massive trends. Others just die out. The edge isn't about having a crystal ball. It's about understanding this landscape of beliefs and spotting where it's about to break.
Now for our third edge, this one is about seeing the world for what it actually is, not just what it feels like. It's about understanding the real numbers behind the digital economy and the huge physical world it sits on top of. That's the informational edge.
6%. That's it. In the developed world, the entire ICT sector, all the software, all the hardware, the whole world of bits, is only 6% of GDP. I know, right? It feels like it should be so much bigger.
And that brings up the most important question of all. The real informational edge comes from getting this. The value isn't just in that little 6%. The real value, the mind-blowing value, is in how those digital bits are used to make the other 94%, the world of atoms, from factories to farms to shipping, run smarter, faster, and cheaper.
And that realization leads us directly to our final piece of the puzzle, the rise of these so-called superstar firms and the incredible, almost unbreakable moats they build using intangible assets to dominate both the digital and the physical worlds.
I mean, just look at these numbers. These are not normal valuations. A handful of companies are now worth more than the entire economies of most countries on Earth. This isn't an accident. This is the logical endgame of that winner-take-most dynamic we talked about earlier.
And here's why it happens. Tangible stuff, like factories, has hard physical limits. Their returns naturally fade over time. But intangible assets, a brand people love, a software ecosystem, a vault of patents, you can scale those things to the entire planet for almost no extra cost. And that creates a moat that doesn't just stay the same size. It gets wider and deeper the bigger the company gets.
So, let's put it all together. Here are the questions you absolutely have to ask now. First, is this a real increasing returns business, or is it just another good story like WeWork? Second, can you actually point to the path dependence and, most importantly, the excludability? What is the real lock-in? Third, what's the story the market is telling itself right now, and where is that story wrong? And finally, how exactly is this company using its bits to win in the real world of atoms?
And I'll leave you with one final thought to chew on. The entire foundation of value investing for a century has been this idea of mean reversion, that great companies eventually become average. But what if for these new superstar firms, that rule is just broken? If winners just keep on winning, what does that mean for the very definition of value itself?